I'm Jeremy Shepherd.
And I'm Damien.
We use data to expose deceitful property experts and their marketing BS. This is the Expert Busting Series.
This is episode 18 of the Expert Busting Series, Buying Under the Median, Why It Doesn't Give You an Edge.
Yeah, so there's lots of industry professionals, maybe not lots, a handful of industry professionals I've heard say that investors should buy a property that is valued below the median for the suburb that they've targeted to invest in. And the idea is that the median is supposed to drag up the value of the property that you've just purchased. And the idea is you're comparing the cheaper property to more expensive properties or the median. The thing is, those valuations of a property are not based at all on the median. The median just does not come into consideration. So the suburb median has nothing to do with the value of any property. And it doesn't matter what the median for the suburb is, the property will be valued based on a comparison of that property to recently sold properties with similar features nearby. So the only thing that will drag the value of a property up is recent sales of similar properties in the same vicinity.
Well, for all the listeners, what is the median, Jez, and how is it calculated?
Yeah, so the median is just the middle figure from a range of sales results over a certain period of time. Quite often you'll see this on realestate.com.au, domain.com.au. A lot of the free data, you'll see them list a median. That's usually a 12-month median. So all the sales over the last 12 months, could have been 50 sales. The market could have moved in the last 3 months, 6 months, whatever. That 12-month median is the middle figure when you list all those sales results in order. So if they range from $1 million to 500,000, somewhere in the middle there, it could be 600,000, it could be 750, it could be 800,000. Whatever the middle figure is, that's the median.
What if you only had two sales over the last 12 months? So let's say you had $1 million sale and a $300,000 sale.
It's the combination of the two. The median would be 650,000. So it's the average of two. So whenever there's an even number of sales, 2, 4, 6, then it's those middle two sales, the average is taken, and that's the median.
And ideally, you want to be seeing a high volume of sales, right? Or there's just more reliability in the data if there are more sales.
For the median to be more reliable, you need more sales. And that's why these free resources have a 12-month median, because it includes more sales. But if the market's moved, then it could be out of date. Yeah, so it doesn't matter what you think the property is worth. What matters is the valuation or the sale price. And the bank will base their valuation on recent sales of similar properties nearby. And similarly, when a buyer is trying to figure out how much they're going to offer to buy that property, they're doing the same thing. When a selling agent or a buyer's agent is trying to estimate value, they do exactly the same thing. They look for recent sales in the vicinity of a similar nature. A professional valuer hired by banks to value a property, they will estimate based on those three things. And this is called a comparable market analysis. If the property didn't sell recently, well, it's not considered comparable. If it was miles away, it's not considered comparable. And if it's nothing like the property being valued, well, obviously it's not comparable either. So every property is valued based on its merits on an individual case-by-case basis. If a property is valued less than the median, then it's for a good reason. The median doesn't drag anything up or down for that matter. So a property will be valued higher if it has maybe something special. Maybe it's on a bigger block, maybe it's in a quiet street, maybe it's double story, it's recently renovated. So properties are valued higher for good reason, not simply because they're cheaper than the median, they're dragged up by the median. So valuations simply do not consider the median. Okay, buying below the median is not a good strategy for a few reasons. There could be all sorts of reasons why a property is under the median. It could be on a tiny block of land. It could be in a greenfield estate on the fringe of suburbia. It could be surrounded by loads of developable land. Cheap does not mean good value for property. And a novice investor might think they've found a good deal simply because the property has an asking price that's under the median. But they may end up paying too much, and that's because it's possible for a property under the median to be overvalued and for a property to be over the median but to be undervalued. For example, property A on the left of this infographic, it's listed for sale at $550,000. But what if the land is valued at $350,000 and the dwelling on top of that land is valued at $300,000? Then the property is massively undervalued. However, the median for the suburb, just have a look at the middle of the graphic there, is $500,000. So that's $50,000 less than the advertised price of property A. On the other hand, property B, that's on the right side, that's for sale at an asking price half that of the median. But what if the house needs to be demolished and the land value is only $250,000? Well, in that case, the property might be $50,000 overvalued. So buyers agents who are on the ground, they're operating in the area every day, that's their full-time job, they're intimately aware of value for money and they absorb a lot more details than any part-time investor can ever hope to. Selling agents, it's the same thing. Of course, they're not going to tell you, they're not on your side when you're a buyer. So the problem is if you focus on buying under the median, you may think your work is done if you simply buy cheap, but instead you need to dig deeper and find out what that property is really worth. Also, if you focus on buying under the median, you're going to ignore half of that market. By definition, the median is halfway along that list of sales. So if you are obsessed with this buying under median, you're going to ignore half the market. So you may miss a property that is really great value for money simply because it had a price tag above the median. And in hot markets where supply is limited, there's high demand, the advice to buy under the median could actually double the time that it takes you to find a property because it halves the number of properties of interest to you. And in hot markets where demand exceeds supply by a cracking margin, it's really hard to get a foot in the door and every week matters. So instead of it taking, say, a month to secure a property, it might take you 2 months. Now, if property's climbing by 2% a month in these sort of hot markets, and we're talking, let's say it's a $500,000 property, then that advice has just cost you $10,000 because the delay, an extra month, 2%, that's for $500,000. If it's $1 million property market, then it's even more expensive advice. And on top of that is the cost of hiring the fake expert with the bad strategy, and who knows what other bad strategies they follow as well.
I think it's just a ploy, right? Just to get the clicks and
it's like a clickbait
like,
thing. It's a pretend experience.
The problem is, I think that as an investor, you can read it as, oh, this person knows what they're doing. Exactly. They're a professional. And then when they go to a professional organisation or a BA firm and go, I want to buy under the median, like that's my answer. It has to, let's say the median's 500. I don't want to go above that. And you got to remember, it's always priced in the assets. And I know we're going to go through it potentially shortly, but it's like there are markets, or maybe we can go through it now.
Yeah.
We can look at, so
let's
if we have a
look at an example.
So there can be a wide spread of
sales
results. So for example, let's just pick, let's just go West Meadows, for example, in Victoria.
This is in Melbourne, yeah.
Yeah, Victoria. We'll just go houses. Let's just say the last 3 months. You can go back a little bit further because if you don't have a lot of sales results, the values potentially may go back a little bit further. But sometimes banks would just get a proper bank val. They won't even get someone out there. And you can actually challenge them. You can say, look, there's some recent sales. So let's say, your property's worth around 900. They give you a bank val of 850. You could go back saying, well, look, there's some of these recent sales. I've done that in the past. And they revalue the property back at 900 for myself to be able to pull that equity out. So I challenged them. I did my own quick check because it's all...
And you showed them the addresses of these properties.
Yeah, I just showed them and said, look, do a quick search on...
But you didn't send them the median, did you?
I didn't send them... That's right. I don't really look at the median. we'll look at the
nobody does. Yeah,
typical value. But let's have a look. So we've got the maps, and as we know,
Where is this in Melbourne? Can you just zoom out
so
a
if we
bit?
go back, I think it's near the airport. So right near
okay.
the Melbourne airport.
Just
so
east of the airport.
we'll zoom in. So like, let's just say, and look, we're not familiar, so we're just going off the cuff here. But if we have a look, so we've got an $840,000 sale, 690. They're pretty much like what, almost side by side, right? So it could be due to the age of the asset. Maybe there needs to be a lot of work done. Maybe the block sizes, but they're pretty much right next door. The other reason is you factor in bedroom count and also bathrooms. I think that has a pretty big play also when you're doing these comparables.
Did they sell at similar dates? Can you just show that again?
Yeah, so what we sold 6th of October. There you go.
2 days apart.
Yeah, let's
Over
have a look.
$100,000 difference
Let's
on the same street. That was good to find straight away.
well,
Good example.
It's a 690. Let's just jump in the property. Yeah, it
maybe
needs a
it's
bit of
the
work.
condition. Okay.
So it could be
It's a
condition.
bit dated, but it's all right.
Look, there could be structural problems.
Oh,
okay, there you go. There could be structural problems. So that's on 556. Abnormal block size too.
Yeah, the shape of the block's a bit.
The
peculiar,
shape.
small frontage.
Looks like it's on a cul-de-sac though.
So
And
quiet,
then
yeah.
if we just jump into this other one, a lot cleaner, renovated. So there you
Okay,
go,
yeah,
right
straight
side
away.
by side. And I'm guessing very similar block size. So 537 versus a 556.
Yeah, similar.
Okay. But I think the purpose of this is like you can go into that same suburb. You've got a 975 sale.
Oh, much more.
You've got
expensive.
one near, looks like it's maybe could be potentially
Double story, or is that a townhouse?
looks like a townhouse. So townhouses in the data can filter through to houses, correct?
Yeah, this one would be classed as a unit for the area because it's only got 2 bedrooms.
2-bedroom. Is there plans to somehow eventually get townhouses?
The problem is there's such a small sample size, whatever data you read from it. Oh, this is houses, this is townhouses, this is terraces, this is villas, it's just going to be rubbish.
You've got a $1 million, so it looks like it's on a bigger block. So again, we're just contact agent, 850, 1.3. So you can see we've got a suburb here with a range, a big range, right? So for me, we do have a reno flip score where if you are looking at potentially doing a renovation, that gives you a widespread of typical sales, right? So you can gives you the opportunity to find markets that have a potential to do a reno flip, right? So
Yeah,
you can buy those rundown properties and fix them up potentially.
Yeah, if there's a really narrow range, like only between 800 and 850, how are you going to do a reno? You've got nothing to compare it with that's more expensive. But if you've got a broad range of like 600,000 to 1.2 mil, then there's more chance. So that's what the spread is.
You've got 600 sales, so there's
They get cheaper over to the east.
to the east. So you got 700.
This is the same suburb?
Same suburb. Let's just bring up let's bring up this one over here. What's this? 706.
That's
Yeah.
townhouse or duplex?
Let's see. We could just filter out by block size. Let's just go 500 minimum, right? Okay, so that cuts out a little bit. 610, 690.
It's a quiet street.
Quiet street.
It's still very cheap.
Cheap. Let's have a look at this one over here.
Bigger block,
size.
decent condition.
Decent condition. So like, again, there's so many variables to it. You could have maybe the further that you're going, you might have that bit of that stigma. You may be closer. I don't know. Pascoe Vale Road might be a little bit noisier.
Dallas.
So you might hear you got
Does
that.
Dallas have a stigma?
More of I think the public housing around there. So again, that might filter through to that site. Again, we don't know until you spend a lot of time doing your own due diligence. But you've got all these factors that you have to dive into a little bit deeper. So you've got that suburb part, but then you've also got to overlay that with what's that property worth when you're actually going in. Because you can easily overpay, but in a hot market, like you said, 2%,
Yeah, it's going to cost you.
in a $500,000 typical value market, it's growing by $10,000. And that happens 10, 15,000, 20,000 a month in growth. So don't get so caught up on the property. But yeah, I thought I'd just flag
Yeah,
that.
that was a good one. You found two very similar properties. Well, they weren't so similar, were they? But they sold on the same date. They're in the same street. But they're in different conditions. So that was a good example.
And it's normal, though, to see a big range of different sale prices, right, in the data, like within the suburb.
Oh, yeah.
It's not super consistent.
can you just back up one more slide?
Let's
I just
go.
had a couple more points about this one. So what if the median is inaccurate? So this happens, like we were just saying, in thinly traded markets with only a handful of sales during, say, a month, for example. You could, by chance, only have a bunch of sales of cheaper properties one month. The next month, they're on the other side of the tracks, or they just happen to be more expensive. There's nothing that's been coerced by agents. It's just coincidence. And so the median can jump up and down from month to month. So if you're looking at the median and it happened to be a cheap month where there's a whole bunch of properties that sold during that cheap month, you may then go shopping for a property that's under the median. You can't find one. So there's another month that's wasted until you get a new median. So first of all, there's issues with missing out on half the market. Secondly, there's issues with the median. And in fact, what if it's the other month where there's just a whole bunch of expensive properties that have sold? Mm-hmm. You then go and buy a property that it was under the median for that month, but then next month it's over the median. So you've sort of shot yourself in the foot if this strategy worked. So yeah, if you look at a reliable median over 12 months, you've got another issue. So I mentioned earlier that those free data sources like realestate.com.au, domain.com.au, they show a median, but it's a 12-month median. So if the market's moving and you're looking at a 12-month median, you're trying to buy under the median, there's not going to be anything that's that cheap. It's already out of date by at least 6 months.
Because of the lag in the data.
Yeah, because the lag in the data for sales results, for starters, and the fact that it's a 12-month median, not an up-to-date median.
Is there a way they can smooth it out a little bit? Like we use typical value. That's the way that we smooth it out.
Well, their idea of smoothing is taking over 12 months. So there's only two dimensions that you can use to get a larger sample size. You can either back up with more history or you can spread out with a wider geography.
Because I would think you'd have a bit more of a weighting, right? So maybe more recent sales would have a bit more bearing on maybe, I call it typical value, but the median, but because they're looking at it the last 12 months, it's trickier,
yeah, well,
right?
we do some fancy things with our typical value to try and bring it more up to date. But the free data sources, it's just a 12-month median, and that's going to give you loads of problems. All right, so here's a hypothetical thought process to show just how silly this advice really is. So imagine if the median did drag up the value of cheaper properties, then for the exact same reason, the median must also drag down the value of expensive properties. So imagine a suburb with a tremendous diversity in houses. One property might be on a small block on a busy road next to a petrol station. Another might be on a large block in a cul-de-sac next to a nice park. Eventually, if this advice to buy under median is correct, then both properties should end up with the same value because of this dragging phenomenon, right? Now, I didn't bother going and having a look at the database to see if that's the case. I don't think I really need to perform that sort of research for everyone to know, hey, it just simply doesn't happen. So you can see just how silly this advice is, how it just doesn't make any sense. You only have to think about it for a couple of minutes. But if a novice investor was listening to this sort of advice, they could be fooled into believing, oh, this is an expert, I should engage their services, I'm going to be much better off than doing this myself. Probably not. Probably an eeny, meeny, miny, mo approach might be better. So there's a lot of marketing dressed up as education, a lot of fake experts getting in the face of novice investors, taking advantage of them. And this is just one of those. So, just keep an eye on marketing that's really just dressed up as education. It's not. Whether you buy above or below median has nothing to do with your property's performance, either in the short term or the long term. What matters is finding a market where demand exceeds supply. There's only one piece of value that investors can glean from this sort of advice, this advice to buy under the median. The only benefit you get from it is that it clearly identifies a fake expert. So if you've heard this advice, you just flag them as a fake expert. And if you know a novice investor who might be trapped by this sort of nonsense, do send them a link to this video. Let them know that this doesn't work in practice. It's just rubbish.
And I think it's more misleading, right? It's misleading.
Totally misleading. Yeah, it's just a fake expert trying to pump themselves up as a real expert. They've dreamt up this piece of advice, and to be fair, a lot of experts do not give this advice. I just heard it from a couple and thought, yeah, it's time for an episode.
And I think the purpose of this series is for all of us to grow, right? Like, we're still learning, we want to get better, and that's a whole idea. And I think share it with other professionals so they're also aware that before they put a post on like this, or buy under the median, that they don't mislead people.
Yeah.
I think that's the whole purpose of this. We all want to grow together. So good episode, Jeremy. So next up in Expert Busting, episode 19, desirable areas, why they often deliver the worst capital growth. Thanks for watching.